and welcome back to Credit Conversations. I'm Jean Sayers and today I'm joined by John Griffiths and Mark England, and we're going to take you through the latest commercial credit lending trends. So John, last time we were here, correct me if I'm wrong, it was just a couple of days before the Conservative government actually called a general election. Just start talking me through, guys. What do we see has changed?
A lot's changed. First we had the change in government, and then it looked like things were starting to pick up again, that we were out of the cost of living crisis and all the challenges of the economy that we'd seen over previous years. We were starting to get growth back. Obviously, we've also had the autumn budget, which has been a big fiscal event. And then again, into the new year, we've seen a focus, a renewed focus on growth.
The big picture, what was been happening over the last 2 to 3 years in terms of new lending, business lending, growth within that. 2024, certainly the first 6 to 8 months of it, really solid bounce back. But then following the budget, and also we have to factor in the US election as well, so following, I guess, a little bit of uncertainty around the direction, that clearly did have an impact, at least a short-term impact on what businesses want to do, some of their aspirations. We've seen it play through. And that manifested in terms of a drop in demand. We saw search activity certainly fall in November, and that has translated to a fall in lending. November was one of the first months in 2024 where lending was actually down year on year. So we did see a short-term impact.
And that was directly following the budget, wasn't it?
Oh, absolutely, and even more so following the US election. Through December, we have seen a little bit of a recovery in terms of search activity. So we are now back in a period of growth year on year, certainly in searches. Whether that can translate to lending activity is something to see. It's something to play through.
Yeah, and I think you've highlighted a good point there. You know, I think there's been a lot of ups and downs across the year and the previous years as well. And it's very easy to talk about the whole economy in the round, but in reality, there are pockets here and there. There are pockets that are doing actually very well. They're seizing opportunities, whether it's specific sectors, specific types of business. And then there are those that have been impacted, of course, by the budget more so than others.
So where are we seeing these pockets of opportunity then? Which are the sectors that are really thriving at the moment?
I think before we get into thriving, I think it's worth just talking about the sectors that aren't thriving, because that's where we're seeing the most immediate impact, if you like, of some of the budget announcements. Even though some of those changes haven't actually taken effect, it's still causing businesses to reconsider pause on some of their business investments. We did some modelling with the Experian economics team looking at the impact of the national minimum wage and the bundle of various national insurance changes that were announced in the budget. And what was clear and apparent is that accommodation and food services, for example, as a sector, with no other changes, we would expect 1 in 5 businesses that were previously running a monthly profit to start to dip into their cash reserves. To a lesser extent, we see it in retail, we see it in manufacturing. So these are all of the sectors that are showing the strongest impact, if you like, from the various budget announcements. The counterpoint to that, though, is there are sectors like computing information services, sectors effectively where there's a lower headcount, where the costs within the business are spread more widely across the various components. They are not going to be as hit as hard by the changes that are coming through.
Okay, so that kind of more tech sector is looking okay. And again, construction as well, I think. So
construction, certainly some of the indicators are positive at the moment. Not necessarily just through the budget announcements, though. I think there's a broader growth agenda, if you like, that's playing through, that's leading to certainly confidence playing through within that sector. I think it is worth saying, though, John, that where we're seeing confidence coming through, certainly for the first quarter of this year, it's weak.
There was the 1 in 5 accommodation and food services industries, and again, care homes, it's obvious when you think about it, lots of low-paid workers. I think we need to also explore a little bit the fact that, to your points you were making, the investments that those businesses are making, it's enough for them to hold back and say, hang on a minute, are we sure we're going to get the same level of growth and the financial projections we need to back that up? And I think that's what's created that sort of slight dip in confidence, slight dip in searches, etc. It's still fundamentally the desire is there, but everyone's just treading a little bit more carefully.
So if people are being a little bit more cautious, what impact is that then having on the lenders?
In certain subsectors, certain product markets in certain subsectors, we are seeing a drop-off in growth. In asset finance in particular, through November, it actually dropped 4% year-on-year compared to 2023 levels. So within certain product markets, the types of borrowing linked to longer-term investment dropped away stronger within November. The lower value lending, well, there was certainly a fall away over the same period, not to the same extent. You break it out by markets though, it's not universal. So mortgage lending is still strongly up on where it was in 2023. And the overall volume and value of business loans, even though it's falling back slightly, is 30-40% up on where it was last year. And one of the key drivers for that is the way that multiple lenders are now feeding into the market. There are plenty of surveys out there that indicate that there's still an underlying desire for growth. So there are recent business surveys by Navuna, for example, which have indicated that compared to mid-2024, aspirations of SMEs to borrow for growth reasons, and that's up to 71%. So there are indicators out there that businesses have an appetite to borrow to grow. They'll just be more cautious in pulling the trigger.
Yeah, absolutely. I mean, I think, again, just to go back to your point around diversification of the market, I mean, that is going to be a key thing that continues into this year and beyond. So we're talking not just about the lenders and the types of lenders and the competition that is fiercely growing in the lender space, and particularly the commercial lender space, but also the types of product and the product use. So we're starting to see not only traditional loan products for these sort of borrowing to thrive type activities, but also increasingly other forms of more flexible finance, not used just as a cash flow device, but also to get through sort of day-to-day spending, but as a mechanism for growth as well.
I think the point about supply is important as well. So whilst there may be an element of caution from businesses in terms of making those lending decisions, we're not hearing that lenders are moving away from the market. In fact, if anything, it's the opposite. If anything, we're getting a very strong feeling that lenders are continuing to look for and expect to see growth through 2025. There might be some bumps in the road. It might be a little weak, particularly at the start of this year, but there's still an expectation for growth. There are more products being launched in the market. So the supply certainly looks like it will be there for businesses. I think it's going to be the demand side in the near term that influences what happens with lending.
How are we then seeing the impact of inflation and interest rates playing through into the market?
So obviously inflation has been high, as we all know, over recent years, and it came down to target last year. What we've seen since the budget is the budget had a little bit of an inflationary impact, and projections show that, I think the forecast is that it will take a little bit longer into this year, next year, for that to come back down to target. That said, inflation did drop and was better than expected recently, and as a result of that, we are expecting interest rates to be cut.
Inflation is going to be stickier this year.
Yes.
It's going to stay above target, I think, for the bulk of the year. The big question will be how some of those budgetary changes, the taxation, the national insurance, how it all plays through. But the expectation is still a path of reducing interest rates, and hence that will give, we expect, businesses a bit more confidence in the direction of travel to invest in growth as the year goes through.
And of course interest rates and inflation are very important for that, because commercial lending and the amount that they pay to service that debt is directly related to the interest rate. So just as it is as us as consumers, a lot of businesses are holding off for those rates to come down.
So based on the current backdrop then, how is that reflecting in terms of business success and performance?
So we've talked a little bit about the slowdown in lending, but the fact that there's still an intent, or we believe there's still intent for growth. There are plenty of strong underlying indicators that point to businesses wanting to invest for growth. I think there are some risks out there to take into account though, and certain trends that we're seeing right now at the turn of the year. Number one is the fact that delinquency rates on commercial agreements are high, almost at record highs. Now it's worth qualifying that with it's absolutely not universal. It does reflect some of the changing risk appetites in the market more than anything, and we're not seeing an indication that the pricing and the delinquency rates are disjointed. Insolvency is still very, very high. They have plateaued or certainly stabilised at a high level. And alongside that, you've got dissolutions, businesses choosing to walk away because the trading environment may be difficult. So it's something that we're keeping a close eye on. And then finally, there's the fact that business creation, so through much of last year insolvencies were high, but business creation rates were also very, very high, in fact higher than the insolvency rate coming through in most months. Over the last 2 to 3 months, there are indications that the business creation rate may be falling slightly. So again, something for us to keep an eye on in terms of risks to the trading environment, risks to certain sectors in particular. Are we seeing the same liveliness in business creation that we saw previously?
Okay, so with all that in mind then, how are things looking for the next kind of 6 to 9 months plus?
Well, I think it's an interesting period now. If we look at what the government has been saying, there's definitely a renewed focus since the start of the year on growth. There's the transition to net zero and energy security and all the industries that will support that. And then there's the tech sectors and AI. There's been talk, of course, of the Oxbridge corridor, and that's not to mention Heathrow, the new runway at Heathrow as well. So we've noticed a shift in the rhetoric, and at the same time, if we are coming out of that period post-budget where businesses have made some of those changes, some of the choices that they may have made in response to that, then potentially the outlook going forward, if we couple that again with falls in interest rates, could help put some wind back into the economy.
I think the first quarter in particular is one where probably expect it to be quite flat whilst people and businesses in particular work through the impacts of the budget, while the trading environment over Christmas and the impacts of that play through. And then it's that question, does the growth agenda and some of the initiatives that have been announced, how does that manifest in terms of growth through the year? I think expectations are that certainly as we get through the second half of the year, we'll see growth certainly tick up.
And I think that's a good point. I think, some of these things, some of these announcements, the growth is going to take time. Things don't change overnight, but the key thing is confidence. And if we can get business confidence sort of ticking up again, then that bodes well for future growth, future lending.
Okay, so maybe we'll get back together in 6 months' time, see if that's all come to a reality. Thank you both for joining me today. I hope you enjoyed this episode of Credit Conversations, and we look forward to seeing you again soon.